July 17, 2025, became a new milestone on Wall Street as U.S. stock indices simultaneously reached historic highs, reflecting a strong combination of positive economic data and an earnings report season that exceeded expectations. An optimistic atmosphere enveloped the market as the S&P 500 rose 0.54% to 6,297.36 points, marking its sixth highest close in just 3 weeks since June 27th. The Nasdaq Composite, heavily weighted toward technology, surged even more with a 0.74% increase, hitting a new record high of 20,884.27 points. The Dow Jones Index also followed the trend, rising 0.52% to 44,484.49 points. Notably, the Russell 2000, which tracks small-cap stocks, jumped 1.2%, indicating that capital flows are beginning to strongly spread to mid- and small-sized enterprises. Behind this impressive surge are a series of solid driving forces. First to mention is the U.S. economic picture, which continues to show resilient vitality. The latest report shows that retail sales in June increased by 0.6%, far exceeding experts' forecast of 0.2%, highlighting consumer optimism and strong spending capability. At the same time, weekly jobless claims dropped to just 221,000, hitting a 3-month low, a clear signal that the labor market continues to maintain steady growth momentum. Not stopping there, production data such as the Philly Fed Index and regional manufacturing activity reports continue to reinforce confidence in the health of the economy. These figures show that manufacturing activity is not only sustained, but also demonstrates a certain recovery momentum, despite global challenges. On the corporate profit front, a series of Q2 reports continue to satisfy investors. PepsiCo made an impression with a 7.4% increase after announcing business results that exceeded expectations in both revenue and profit. United Airlines also contributed to the positive picture with a 3.1% rise, thanks to a favorable profit report. Notably, TSMC, a giant in the semiconductor industry, announced record profits, fueling the technology stock group and pushing the Nasdaq further away from previous highs. The ripple effect of good business results not only stops at large enterprises, but also supports the entire range of stocks, especially small-cap groups, as reflected by the Russell 2000. However, behind the vibrant green of the market, there are still lingering concerns about politics and policy. This week, President Trump continued to openly criticize Federal Reserve Chairman Jerome Powell, with even rumors about the possibility of firing Powell. These statements sparked controversy over the Fed's independence, causing U.S. Treasury yields to rise and the dollar to weaken at times. Nevertheless, investors seem to have become immune to short-term political fluctuations, quickly returning to stocks due to confidence in the economic fundamentals and corporate profits. Another important factor is the Fed's monetary policy. Governor Kugler has just reaffirmed that interest rate cuts will be temporarily paused, amid inflation risks from trade tensions that remain uncontrolled. Although some tariffs have been temporarily suspended, new threats of tariffs continue to increase inflation expectations, making the Fed more cautious with its next steps. In addition, fiscal issues such as the public debt ceiling or the possibility of extending tax cuts, although not prominent this week, remain uncertainties that could cause significant market volatility next month if debates in the U.S. Congress become tense. Looking at the trading session on July 18, 2025, experts predict a session with mixed volatility, but the main trend remains positive. The factors that will continue to lead the market are new economic data, such as housing starts and consumer confidence index figures. If these numbers remain optimistic, the financial and industrial stock groups could benefit significantly. Additionally, investors will also pay attention to new statements from Fed officials, as any dovish signals, meaning easing trends, could boost the technology sector to continue breaking out, while hawkish views, meaning caution regarding inflation, could restrain small and mid-cap groups. The earnings report season is still ongoing, with major names like Netflix set to announce their Q2 results, along with Morgan Stanley and Bank of America. The figures from these companies could change the sentiment across entire sectors, especially as tech stocks are currently the biggest growth drivers in the market. Regarding risks, any new developments in trade policy, such as announcements about tariffs or trade negotiations, can cause significant volatility. However, with the market having demonstrated resilience to recent political storms, investors are more confident in its ability to absorb short-term shocks. In summary, the U.S. stock market is benefiting from a combination of strong domestic consumption, outstanding corporate profits, and investor calmness in the face of political fluctuations. Forecasts indicate that a moderate upward trend will continue, led by the technology sector and large-cap stocks. Small-cap stocks may slow down if bond yields remain high, but volatility risks remain moderate unless there is a major surprise from monetary or fiscal policy. In that context, investors should continue to pay attention to fundamental factors, especially the consumption situation, earnings reports, and actions from the Fed, to be prepared for new fluctuations, while taking advantage of opportunities from sectors that are attractively valued and have long-term growth potential.